Good morning, my name is Przemysław Kwiecień, I'm Chief Economist of the XTB, and it's my pleasure to have you on our weekly trading webinar. So today our topic is inflation week, because during this week we are going to have some inflation data in each of the days, but crucially we're going to have April US inflation figure on Wednesday, but we'll get there slowly. Let's start with the top news on Monday morning, and it's pretty much digesting what we had towards the end of last week, where the NFP report for April in the US was at just 266k, which maybe is not bad, but markets expected nearly 1 million of new jobs. What was more striking than the data, which is volatile, especially the NFP print, this headline print, it's very volatile from month to month. It could be easily 1 million next month. So it's not like, you know, the labor market is crashing or something, but it's what was more striking was the Fed official Neil Kashkari, who immediately after the data release was happy in the Bloomberg TV. So it's incredible these days that markets react with new all-time highs to weak report because the Fed official is happy with the weaker data, because that means that they have more room to keep operating the QE program. If you look objectively at the report, you will see that actually the labor fund is at the record high already, because even though the increase in employment was much less than expected, then there is some wage pressure in the data, and you can see that already US households have more disposable income from labor than they ever had, and obviously they have a lot of transfers as well from Biden checks, from unemployment benefits, and so on and so forth. So their spending power is very robust. This is the reason why bond prices erased their early gains. But like I said, with the Fed unwilling to blink and unwilling to even consider limiting their expansion, we'll explain why in a few minutes. Markets keep soaring. What keeps soaring are pretty much anything, but 2 weeks ago we discussed commodities, especially industrial metals, as the markets that are doing well during the times of reflation, and you can see what's happening with copper prices today. The opening is nearly 11k, where just 2 weeks ago, where we met last time, I think we were around here, around these records, which already seemed high, but obviously right now we are so much higher. So the pace of increases of anything is just stunning, and obviously this is going to lead to some inflation pressure. So this is certainly going to be interesting. But before we get there, let's start with indices and the sentiment data, which I prepared for you. And you can see that here with this red plot is represents market sentiment, and as you can see, lows and highs of the index more or less represent lower and higher points of the S&P 500, and we had 2 high points in the last couple of months as signals of potential overheat on the markets. But will this work? So here on this chart, maybe I'll give full screen here, you will see that previously, whenever this index, which is a combination of couple of smaller indices like deviations from averages, put call ratio from the option market, VIX, and a few others, whenever it crossed 138, it cannot be visible here because this scale is fairly dense, but whenever it crossed 138, it usually led to deeper or shallower correction, like here. The only time when it didn't was December 2020, which is a bit concerning because this is the latest phase of the market. And again, we had this crossing last month in April, and again so far it hasn't yielded a correction. What is interesting here is that this sentiment index actually softened a little bit, so it's unlikely to cross 1.5 in the nearest future, whereas this 1.5 was before the pandemic. It was like you can see here, kind of bulletproof signal, where when in three situations which were in actually one was post-pandemic, it was August of 2020, but 2012, 2018 and August of 2020, it always provoked a correction in the near term. This changed in December when the signal was false, but 3-to-1 is still a very decent ratio. But like I said here, despite the records on S&P 500, despite the very high Nasdaq, despite the records of Dow Jones, it's the sentiment is still obviously overbought, but it hasn't peaked, but instead it has softened a little bit. So from that perspective, we can say that it's really hard to tell where is the end in the near term for indices, because even if you look at the DAX that had tough moment last week, where we had this head and shoulders formation in this very, very consistent upward channel, the bottom of the formation was broken, and it looked like we could possibly have some bigger correction, but obviously, as you know, it hasn't materialized. The markets turned around fairly quickly, and actually the bulls used this bottom of this formation as a support here, and then soared above this resistance point. So frankly speaking, it doesn't look like it's bearish right now. I mean, at least looking at the market. Obviously, markets are hyper expensive, the most expensive ever by many measures. The markets are overbought, as I just showed you on the sentiment index, although not extremely. But here on the charts, it doesn't look like any major pullback is imminent. Of course, we had, like on the DAX, we had this bullish gap which now has been covered, but this is very short-term thing. You know, on the larger scale, it doesn't change a lot. You know, you had this situation here where there was a gap, it was covered. Okay, markets pulled back a bit here, but here there was a gap, it was covered, and then nothing happened. There was some consolidation and continuation of upward trend. So right now, looking at indices, you know, if you have strong economic growth, and if you have at the same time Federal Reserve that tells you we will print whatever happens, then it's really hard for the markets to ignore, and obviously we are, you know, pumping the bubble, which may not end well at some point, but for now the momentum is there. So yeah, let's move to the story of the week. And actually we had some signs of normality last week when Janet Yellen, previous FOMC president and now Treasury Secretary, said that maybe at some point this hot economy will require higher interest rates. So obviously this was this moment when this DAX blown through the support zone, which you saw a few minutes ago, and what she said obviously wasn't anything awkward. She said something very obvious. You know, with inflation pressures, as you can see here, the highest since 2008, when we had oil at 150, with such a strong reopening, it's probably natural to, you know, put the foot off the accelerator a little bit. But obviously with the markets so much dependent on this acceleration, we obviously instantly had the chorus of the FOMC officials saying that no, we're not there yet, we need more time, and so on and so forth. So obviously this is going to be very interesting, how it plays out with the Fed trying to ignore everything. Then it's there. Why are they doing this? Is pretty obvious to me, because if you look here, this chart maybe is not very transparent. Let me give it full screen to you, because I wanted to show you 2013 when we had strong bull market and strong QE from the Fed. Then we had 2018 where the Fed started withdrawing some of this accommodation through balance sheet moderation, let's say it like this, because these declines were fairly modest, but at least they were trying to contain this balance sheet. And at the same time, Treasury issued quite a lot of bonds on the net basis. So, and if you look at the markets, this was the first year since 2008 which was negative, the first and the only year so far that was negative for S&P 500. So obviously this net supply of new money or net withdrawal has big impact, and in the months to come the Treasury will need to issue a lot of debt to cover huge deficits, because obviously these Biden plans are not free, they need to be financed somehow. And the Fed, obviously they helped with the financing massively, but even with the QE at the latest level, it will not be enough to cover all the new financing. So obviously if they started hinting at the taper, which means the smaller purchases here, the gap would be higher. So obviously this is a very strong reason why they are trying to ignore everything. So this means that we will have kind of inflation showdown, because inflation, it seems like inflation is the only factor which can spoil the party here. As you see from this Bloomberg consensus, quite recently the expectations were that inflation will be just slightly above 3% towards the end of the current quarter, whereas this week we are going to have, like I said, a lot of inflation releases, and this US inflation data on Wednesday 1:30 p.m. So and already the consensus is 3.6%, so it's already much higher for April data than the markets thought inflation would be towards the end of the quarter. Obviously this is just the consensus. It might be lower, but it might be also higher, because we have very strong base effects from previous year, and there are many factors contributing to inflationary pressure. I just showed you copper, but there are iron ores, there is lumber, there are so many shortages that build up on the supply side of the economy, and yeah, it means that and the wage pressure which we started from. So really inflation is the only factor, but the very strong one that can spoil the party here. However, short-term wise, let us remember that last month inflation turned out to be higher than the market expected, and bonds and stocks reacted positively to it. So you know, these markets are really strange these days, and while this broader picture seems pretty transparent, and certainly if inflation continues rising and is, you know, reaches some scary 4% plus levels, then it's not going to be good for these markets. But short-term wise, you know, we saw so many surprises last few months that, you know, you can never be sure that, for instance, you can get 3.8 and the markets go down, or indices go down, or bonds go down. Many stranger things already happened. We already took a look at the indices, so towards the end of our meeting, let's take a look at gold, which had a very good week. Obviously this NFP was a big factor. Why? But as you can see on the bonds, this whole reaction, which was quite strong initially, was fully reversed. So this doesn't bode very well for gold, and while the trend here is very strong, so you usually want to stay with the momentum. You also need to be reminded that we are looking at the move already similar to what we had here towards the end of 2020. So yeah, it looks like some profit taking here may take place, even if the low is already there. So this is gold, and the euro dollar is also interesting, as you may see here, with the defense of 120. The markets, the pair returned to the upwards trend and is already quite close to this level here, 121.85. We may see a test soon, but also when you look at the dollar index, which is USD IDX, you will see that there is a decision to be made. The whole rally, or maybe rally is not a good word, but the whole recovery here now it's been wasted, and we are back at the 90 area for the dollar index. That proved to be a turning point on a few occasions for the dollar. And the question is what's going to happen, because technically higher inflation should be positive for the dollar, because it should provoke higher interest rates. But if the Fed keeps ignoring inflation, if the inflation is going to rise again above the consensus, and the Fed will continue saying we will do nothing about it, it will be negative for the dollar, because it will be a risk towards the stability of the currency in the long term. So it's, it really depends how, if, for instance, first of all, if the inflation is going to be higher, and if the Fed eventually needs to do something about it. These are two factors that the dollar needs in order to recover from this big and dynamic slide. So high hurdle for the dollar, but then again the levels once again are quite interesting here. Ladies and gentlemen, thank you for your attention. Please stay with us in the news section of Xstation mobile platforms, and we see each other next week on Monday. Have a great week. Bye.